feelings can be a powerful motivator for behaviors. And think about that's, that makes evolutionary sense, right? Take fear as an example. Thousands of years ago, we hear a rustling in the bushes. Fear
Hmm.
causes us to run away and keep from being eaten by the saber-toothed tiger. If we're too afraid, it turns out just to be a bird in the bushes. No big deal. If we're not afraid enough, we don't have that action, we get eaten, right?
Yeah,
Um,
huge consequences.
so yeah, it's these emotions are important, but in a modern context, it doesn't always work to our advantage.
Welcome to the Morris Financial Contest Podcast. I'm your host, Richie Gerzon, and today we have Bart Valley back to talk about behavioral finance and the psychology of investing. Bart, how are you doing?
I'm doing great, Richie. How are you? It's good to be with you again.
Yeah, I'm doing great. I'm glad to get you back on the show. This is a really interesting topic, so I can't wait to learn more about it because I think I'm going to learn a lot in today's
Sure.
episode. Bart, can you explain the concept of behavioral finance and how it relates to the psychology of investing?
Yeah, absolutely. So, behavioral finance is the study of psychological influences on investors and financial markets. And this is exciting. As you mentioned, Richie, I think it's a really interesting area, and it's one that's near and dear to me because, I've got a background in economics and I've been working
Mm.
in the investment field since 1994. But I've also got a master's degree in clinical mental health counseling and spent many years as a practicing licensed professional counselor. So this intersection of psychology and finance is just really interesting. Um, and I think a great topic. And just to give you a just quick kind of 1 minute background on this field of behavioral finance, it
Yeah.
started in the late 1970s, early 1980s, when basically a couple of psychiatrists and an economist got together and they said, let's study how emotions and thought patterns, many based in maybe based in deep-seated subconscious biases, how those emotions and thought patterns can affect the ways we make financial decisions. So it's a really important field of study. Two of these individuals actually won the Nobel Prize for their subsequent work in this arena. And importantly, understanding behavioral finance can provide us with a roadmap for making better, more rational investment decisions. So it's a really important area of study.
Oh, it sounds like it is. So, how do emotions like fear and greed impact investment choices? Does it really mess with your investment decisions?
It can, absolutely. So, like with so many aspects of life, our thoughts and our feelings and our behaviors can be intrinsically linked. So, feelings can be a powerful motivator for behaviors. And think about that's, that makes evolutionary sense, right? Take fear as an example. Thousands of years ago, we hear a rustling in the bushes. Fear
Hmm.
causes us to run away and keep from being eaten by the saber-toothed tiger. If we're too afraid, it turns out just to be a bird in the bushes. No big deal. If we're not afraid enough, we don't have that action, we get eaten, right?
Yeah,
Um,
huge consequences.
so yeah, it's these emotions are important, but in a modern context, it doesn't always work to our advantage. So an easy example to think of is like market cycles. So if you're investing in the stock market, right? I'll try to draw a stock market cycle. We know stocks go up generally, but they have cycles up and down. And think about the emotions that go along with those cycles. So let's say we buy into the stock market here. We're feeling optimistic.
Yeah.
Stocks start going up. We're feeling a little more excited. They continue to go up. Maybe we're thrilled or euphoric at this point. Then the market starts to correct a little bit and we're surprised and it goes down a little bit more. Maybe we're nervous, a little bit more, we're worried, a
Hmm.
little bit more. Now we're like panicked. And those
Yeah.
feelings are natural, but think about the actions those feelings might motivate. The motivator for wanting to buy more, that tends to come when we're up here feeling euphoric. And the motivator for wanting to sell tends to come down here when we're feeling panic. So we're buying high and selling low if we're acting on our emotions. And that's
The exact opposite of
exact
what we should be
wrong
doing.
thing to do if we
Okay.
actually want to make money. So again, those feelings that are natural things in a modern context can get us in trouble sometimes if we don't check them.
So, in addition to emotions and feelings, thoughts can also affect our decision making. Like, talk to us about cognitive bias and how that would come to play.
Absolutely. Yeah, that's the thought side of it. So our thoughts can also be problematic. So cognitive biases are systematic errors in thinking systematic errors in thinking that can occur when we are trying to process or interpret the world around us. And they can come from lots of different places. They can come from information processing shortcuts that we all have as humans. They can come from emotional motivations. They can come from distortions in thought. They can come from social influences. So cognitive biases can come from a lot of different places, but they're all ways in which our brains can easily mislead us, especially when it comes to money.
Can you give us a few examples of some common cognitive biases that people might fall prey to?
Yeah, so there's lots of them. We all use cognitive shortcuts, and they can be helpful. Again, they can help make decision making more efficient. But in a complex world, relying on these quick assessments and these kind of shortcuts, that can lead to problematic decision making. It can lead to deviations from rational thinking, and so it can be a real problem with money and investments and finances. So part of our job as advisors is that we need to be really skilled in identifying and mitigating these cognitive biases. So again, there's lots of different types, but ones that come to mind and can be most notable in working with clients would be loss aversion bias. Overconfidence bias is certainly a big one. Herd mentality is one we see a lot. Confirmation bias and hindsight bias would be another big one.
So, all of those are types of cognitive bias.
Yes, those and more, but those are probably the most prevalent ones we see that affect decision making in an investment context.
All right, so let's dive a little bit into loss aversion. That's an interesting one. How can that affect how we invest?
Yeah, so loss aversion is very interesting. It turns out that we as humans are imperfect judges of our own self-interest. And we have a strong natural aversion to loss.
Hmm.
Simply put, we tend to feel the pain of loss more intensely than we might feel the pleasure of gain. And
Oh,
so
that's
it's,
unfortunate.
yeah, yeah.
I gotta
And,
rewire
and
my brain the other way.
yeah, yeah. And it's something that is natural kind of human condition.
Hmm.
It's real interesting. Daniel Kahneman, who I've mentioned before when we've spoken on some other subjects, but he's one of the three individuals that started this field of study and a Nobel Prize winner. But he used to do a really interesting experiment with loss aversion bias with his students. And he would say, we're going to do a coin flip, right? 50-50 chance of heads or tails. If it
Yeah.
lands on tails, you lose $10. And then he would say to the students, what does the gain need to be to get you to take that risk of losing the $10? In other words, what does the gain for heads need to be to get you to play the game?
Oh,
The rational answer would be $10, right? Then you're a 50-50 chance of coming out, maybe it's $10.01. So
yeah.
long term, I might come out ahead. But um, the average answer, it typically tended to be over $20. So it just
Wow.
shows that skew of, again, feeling loss more acutely than feeling the pleasure of gain. So that can be really problematic in an investment context where risk and return are inextricably linked, right?
Yes, that's interesting.
Yeah.
Well, how about something like overconfidence? How would that affect your investment choices?
Yeah. So overconfidence, we tend to overestimate our own abilities. A great example, AAA let us know through a study that 73% of us think that we are above average drivers, right? That can't work.
Yeah.
So
Okay.
again, that's a great example of overconfidence bias. But overconfidence bias, and also a related bias that we can call self-attribution bias, and that's where we tend to attribute successes to, or if it's a successful outcome, we tend to attribute that to our own great internal factors, right? Where if it's a failure, we tend to attribute that to external factors. That's the self-attribution bias. So these two in combination, overconfidence and self-attribution, collectively, it can lead investors to overestimate their own skills, to make increasingly more risky investments, and
Mm.
ultimately maybe lead to larger losses than that investor can tolerate.
Okay. Well, what about herd mentality? I've heard behavioral economists talk about that. How can it affect the market and or individual investors?
Yeah, and we've seen some. Yeah, it can be individual or a market phenomenon, and we've seen some of that recently. But again, herd mentality, it's something, we can also call it fear of missing out or FOMO. That would be another good description
Oh, I
for.
have not heard them combined. That makes sense.
Yeah, it's herd mentality. Again, it's evolutionarily powerful. People have a natural tendency to want to fit in with the group. We want to be in with the herd, right? But that can lead in investing, it can lead us to follow and copy what others are doing. It can lead to bandwagon, kind of trendy fad investing. And so examples would be like tech IPOs in the late 1990s. Everybody needed to be in these tech offerings.
Mm-hmm.
Maybe digital assets or meme stocks you may have heard of more recently. These really trendy things that kind of take off for a while and then don't have longer term staying power or aren't based on any underlying fundamental data. So the more rational decision is for an investor to research each investment carefully, and select ones that are appropriate for their specific circumstances and their specific needs rather than following the herd.
Can you talk a little more about how social influence can impact investment choices?
Yeah, just kind of going along with that herd mentality. Social influence affects us. It affects us as humans, whether it's friends, family, coworkers, wider social networks, even social media. It's going to affect us to various degrees in lots of domains of our life. So, take for example, when a coworker or an uncle is talking about their investment successes. And by the way, you only hear the talk about the successes, right? You never hear the stories about the ones that didn't work out so well.
Right? That's true.
Exactly. But when you're hearing all those great stories of how well everybody did, naturally that's going to have some influence on you. But it can lead you to decision making that your decisions that maybe aren't rational or appropriate for you, given your goals or needs. And so we got to watch that social influence. Again, lots of ways, but specifically with investing, it can be problematic.
What about confirmation bias? Can we talk about that a little more broadly, what it is and how it can affect our investment choices?
Yeah, confirmation bias is one of my favorites, and it's one of my favorite ones to talk about. We've mentioned it before on
Hmm.
our
Yeah, I
previous
recall.
talks, but it's basically where we have a bias towards seeking out and accepting information that confirms what we already believe, and perhaps avoiding or ignoring information that might be to the contrary. So we see
Even
this.
scientists are guilty of that, if I
Yeah,
read
we
correctly.
science, it's a big thing in science if you're not designing experiments appropriately. And we see
Mhm.
another politics is another great example. Again, as the country has become more fractured politically, sometimes we like to stay in our own little political spheres and look for things that confirm what we already think, right? So it can be problematic in lots of ways. But it exists because it helps us avoid the emotional discomfort that comes from thinking we might be wrong. So, but it's problematic. It's maladaptive, as we might call it in psychology. So, with investing, again, it can lead to overconfidence. It can lead to inappropriate or risky decisions. And importantly, it can lead to failure to learn from our mistakes, which is important, if we want to be successful in the long term.
So this reminds me of another one we've talked about before, hindsight bias. Can we go over that, what it is again, and how it can affect us and get us in trouble?
Yeah, hindsight bias is another another important one. And this is the tendency to view past events as being more predictable than they actually were. So after an event happens, we tend to get more data on that event
Yeah.
afterwards. But we go and convince our brains trick us into believing that we knew more than we did beforehand. And
Uh,
so our tendency is to try to sometimes package a really complex series of events into a nice, tidy little story. And it can cloud our objectivity. So, examples are like the 2008 financial crisis, or the rise of Apple stock is one we've mentioned before. Even last year, the interest rate increases that happened last year. We look at it after the fact and say, oh, maybe I should have seen that coming. But really, if we go back and examine it, the data didn't lead us to those conclusions before the events happened. And so it's important to be able to recognize that one, and to be aware of it, and be able to mitigate it.
that makes a lot of sense. So, do we have any strategies that could help us assess these past decisions, kind of look at them more objectively, help us avoid some of these issues?
Yeah, and so thoughtfulness, reflection,
Hmm.
accountability where it's necessary, and even sometimes cutting ourselves some slack. Like, again, with hindsight bias, that would be an example of cut yourself some slack. We hear a lot like, I should have known, or I should have seen it coming. Not necessarily, and lots of times not really, right? So accepting that the future is not as predictable as it seems after the fact, embracing uncertainty and planning around that uncertainty, as we've mentioned in the past.
Are there any other cognitive biases that tend to pop up in the course of our investing?
Yeah, again, a couple others that I might mention. Recency bias is one.
Hmm.
Recency bias, or availability bias, is another name for that. That's where we have a tendency to put too much emphasis on recent events.
Yes.
And yeah, and this, if you look at this in combination with those emotions, that I talked about earlier,
Uh-huh.
can be really dangerous in getting us towards like a buying high or selling low scenario. Those two in conjunction can be very dangerous. And versus, investing based on a sound plan that's based on research and looking at decades of market history. So looking longer term rather than just what's happened in the past year or two, is important. Another one, that we see, again, something we all have as humans, is a bias towards action. And this is one that's, again, evolutionarily
A
powerful.
bias towards action, is that
Bias towards action, right?
okay? Yeah, that's
What that
interesting.
means is when we're in pain or we're in discomfort,
Yes.
we want to do something, right? We want to
Uh-huh.
act, to get rid of that pain or discomfort. And so, a real easy example is I just walked down and accidentally put my hand on the stove burner that was on 2 minutes ago. I'm going to jerk my hand off
Oh,
there
yeah.
real quick. That's kind of a subconscious reaction to that physical pain. But even with emotional pain or discomfort, we want to do something. And so that's true also, like with money. When we're losing money, that causes emotional pain, and the tendency is to want to do something, which can be problematic with investing, because oftentimes the best answer is not to do anything at that current time. And so,
Oh, that makes a lot of
yeah,
sense.
it's, going back to 2020 as an example. When COVID hit and the markets went down, rapidly, and they went down a lot. People sitting around in March, a lot of people, the tendency was like, I don't know what's going on with the markets. I don't know what's going on with the world and this virus. Let me just pull my money out and set it in cash for a little while, and we'll figure this out later once we have a little more stability. Well, that didn't work out very well for people that did that, and the more rational decision was to stay invested with a longer term plan. And people that did that were rewarded through the rest of the year, even though it was a time of uncertainty. So again, some of these biases that have evolutionary basis, or have served us well over time and still serve us well in some ways, don't always work well in the context of investing.
Absolutely. So, how much of an impact can poor decisions being made based on these cognitive biases on any of them, how much of an impact can it make on an individual investor?
Yeah, it's a great question, Richie, and because these are real behavioral mistakes that can happen, and it leads to real money being lost if we're not careful. So, it's hard to put a dollar amount on it. It depends on the investor, but it can be really significant. And I'll go back to that 2020 example of the markets during that COVID period. Think about let's think about three investors and say they each were invested like in a balanced portfolio. Say they had about 60% invested in stocks and about 40% invested in fixed income.
Yeah.
That was their longer term target, right? What happened during the first months of the year and especially in February and March, that equity piece, it lost a lot of money, right? So you were well under your 60% target as equity markets went down significantly in a short period of time, whereas fixed income markets stayed kind of flat. They were more resilient. So sitting around in March, that person that was 60-40 was not 60-40 anymore. They were much more underweight their target equity allocation. So let's say we had three investors that were all 60-40 investors, and one said, you know what, I'm kind of cool with this long-term plan, but I'm a little jittery, but let's don't do anything. Let's just leave everything like it was. Let's don't adjust anything.
Yeah.
Let's go forward. That person, it worked out pretty well for him by the end of the year. Second investor said, I can't take this anymore. There's too much unknown right here. Let's just go to cash and sit on the sidelines. We'll get back in a year or so, 2 years. Let's just see what happens. Didn't work out well for that investor. Now, the best outcome would have been for a third investor that said in the middle of March or the end of March, hey, I'm underweight my equity allocation. I need to be buying more stocks right now. Which,
Mm,
again, if you're following a long term plan, that's the rational decision. But that was a decision that was emotionally difficult at the time. It was cognitively difficult at the time. So that's something we helped our clients with. We did a lot of rebalancing in March, and those investors that were able to do that rebalancing and get back to their longer term plan, they had the best outcome through that period, even though it was a difficult thing to do.
yeah, it must have been a very difficult thing, but I could see if you could just step back and kind of almost like you should make a checklist. Am I doing this, and then make a decision because it has such a huge impact.
And it's hard, and especially when it's a personal thing. And so that's part of that's part of our job for our clients is to
Mhm.
manage those things, to take the emotion out of investing, and to take that kind of burden of decision making off of our clients and
Yeah,
carry
that
that
makes
on our
sense.
shoulders.
All right. So, what about new technology? So, we have a lot of real time data at our fingertips. How has that impacted the psychology of investing? Has it presented new challenges or even maybe some opportunities?
Yeah. I love that question because it's a wider question, right? Technology impacts every aspect of our life.
Yeah.
So I think as with most life domains, technology and the availability of information can be a blessing or a curse, depending on how we're using it. And specifically with investing, if we're using technology and this kind of real-time data, to do research or to do other things, and we're using it in the right way, it can be helpful in conjunction with the other strategic things we're doing. If we're using it in the wrong way as investors, so in combination with or in support of some of these biases that we talked about, so we're using real-time data along with herd mentality bias or with recency bias or with confirmation bias, as we've talked about, those things can get us in trouble from a dollar standpoint as investors. And technology just puts fuel on that fire if we're using it in the wrong way. So again, part of our role is to keep clients focused on our longer term strategic plan for them, but also to be able to stay abreast of ways in which we can use technology to be more efficient in what we're doing, and to leverage those tools when we can to do a better job for our clients.
So, are there any other strategies we can use that investors can use to help avoid these cognitive biases in the future?
Yeah, I think the biggest thing, Richie, is just to acknowledge them. And, that's part of what we're trying to do here today, to acknowledge these cognitive biases, to know that they exist, to understand them, to be able to recognize them when they're happening. Again, this is something we do with our clients. We've been doing this a long time and we've seen a lot. So we're pretty skilled at recognizing and identifying these biases and developing strategies to mitigate them.
Mhm.
Individuals, if you're out there trying to do this on your own, you need to be able to do the same things and recognize, say, hey, I'm focusing on things that are confirming what I already believe. Let me look at some wider data and make sure I'm making a rational decision here. Understanding and addressing these biases. And I would say, look, we all as humans are prone to cognitive biases. We're sometimes prone to emotional reactions. Which can lead to behavioral mistakes, right? And so we try really hard in what we do to understand these biases, to develop strategies to address these biases, and really to help our clients avoid these missteps.
It really does seem like having someone like you can make a huge difference, because I know when I get very emotional, that is when you make the worst decisions, and all this can affect your future in a big way.
Yeah, absolutely.
Well, Bart, thanks so much for being on the show again. Of course, once again, I learned a ton and I can't wait to have you back.
Thanks a lot, Richie, and we'll look forward to talking to you soon.
All right.